Hello. The annual general meeting of SMRT on the 29th of July is going to be a very interesting affair indeed. The main topics of discussion will be the cut in the dividend, the reinvestment needed in the train and bus services, the possible divestment of train and bus services, as well as how some of their operations overseas are faring. All of this because of the recent issues that SMRT faced from the train outages in late 2011 and the scramble since then to get the business performing at peak again. Let's have a look through the annual report to see some of those things show up and things that you as shareholders need to know before you attend the AGM. The fact that the annual report is called Getting on Track suggests already that there are a number of things that have come off the rails. Here is the chairman's message, in which the chairman points out that they're looking to stay the course in the face of the challenges. But the challenges are formidable. Let's zoom in on some of them. The first is the cost of operations is expected to rise in the coming year as they work to maintain and rejuvenate the aging rail infrastructure. In other words, more investment is required. And tellingly, under the present operating regime, that increase in costs is going to grow faster, it seems, than revenue, and that will impact their cash flows and borrowing costs. And here's the killer line in the statement. It will subdue our profitability and impair the long-term sustainability of the business. In other words, we don't know whether SMRT can continue indefinitely in its current form. Changes are needed. So there are little side stories to this, such as the impairment of their Shenzhen Zona investment, $17 million impairment that was already announced at the time of their full year results. In essence, the concern is that there's some uncertainty over the government subsidies for the public bus operations, as well as increasing competition and business costs. That's gotten a lot of airplay, but in actual fact, there is a much more important issue at play, and as I mentioned, that is costs and the viability of the business. When we look at costs, you see that here in the blue bar. Staff costs still make up the foundation of that. Here we are, this is the 2013 number, almost 400 million, partly because of pay rises. I'll come back to that. But we've also seen just a slight decrease in energy costs, one thing which once again gets a lot of play in the newspaper. But what we can see here is that it's actually not that important, certainly not compared to the $200 million that they spent on so-called other operating expenses. Lawyers, for example, service providers, and that $2 million fine that they paid to the Land Transport Authority. Depreciation is also a line item which is almost as big as energy costs, and yet depreciation barely gets a mention when we look at the media. So overall, what you can tell from this is that they have a very substantial amount of costs, both fixed and temporary costs, particularly where the rejuvenation of their rail network is concerned. More recently, those salary adjustments that I've mentioned, well, they hope that they'll be mitigated by the wage credit scheme and productivity improvements. But again, here's the very interesting line about this paragraph. We are also proactively pursuing conversations with the government on new financing and operating frameworks to ensure the long-term sustainability of the train and bus services. What does this mean? Conversations about financing and operating frameworks. We get a clue in this paragraph, where they say that the discussions would see a shift toward an asset-light ownership model. In other words, that SMRT simply wouldn't own all the rail and perhaps even rolling stock and bus infrastructure that they currently do. And all of this is to happen in the near term, which would present the group with a more predictable cash flow stream. So in the near term suggests that an announcement could in fact be imminent. Because after all, near term doesn't mean medium term or long term. So you can see from that that there is a lot of possible big changes in the way that SMRT operates. And I'll come back to the asset-light model in a minute. Just let me briefly point out here the difficult decision that they had to take in relation to the dividend payout. I'll come back to that shortly as well. Let's zoom in on what this asset-light strategy might look like. And this orange bar here in the middle, property, plant and equipment with more than 1.4 billion, seems to be it. In other words, this is where all that rolling stock and the track infrastructure is housed. If they now switch to an asset-light model and they were to become, let's say, just a train operator rather than a train owner or a track owner, this bar would in essence largely disappear. In other words, this would come off the balance sheet and they would no longer be the owner of these assets. An asset-light strategy would mean that they would become a service company rather than the owner of those assets. At this stage, obviously, we still await word on what exactly this new model might look like. But again, that's perhaps something you can ask about at the AGM. So, very interesting chairman's statement. You'll find these charts and graphs dotted throughout the annual report. But again, please read the chairman's statement before you see the statement, rather see the chairman at the annual general meeting. Back to the dividend, which I also mentioned, and here it is on this chart or set of charts. The dividend per share for the full year amounted to just 2.5 cents. You can see that represented by this blue line, down from 8.5 cents in 2010 and 2011. So a very, very low dividend by comparison, because obviously they're keeping their powder dry. They're obviously looking to save their resources for actually improving the rail infrastructure. Revenue continue to increase, more than $1 billion for a second year running, but once again we see profitability dip down, and you can see the profit margin here at 7.4% is quite a thin margin, considering that it was at 18.5% back in 2009. So again, imagine if you're the chairman or the chief executive, you'd be looking at all of this thinking, something's got to change. I find these set of charts arguably the most interesting, because they show you how the various parts of the business are performing, and it also suggests to you which parts you should be getting rid of, which parts you should be selling. First, let's look at trains, buses and taxis, because this is where the revenue bar is the longest, but also where the profitability bar is the shortest. In fact, for buses, they're making a loss even though they have more than $220 million worth of revenue. Incredible charts, aren't they? A lot of revenue, very little profit or no profit at all. And you know, when you consider how the bus and the train businesses operate, it's no surprise. Obviously, the fare increases that are so unpopular with travellers is exactly what SMRT needs in order to sustain the business and pay for its increasing costs. The group's profitability will continue to be impacted, they say, by those cost challenges, particularly in the fare business, as its outlook depends on ongoing government initiatives to restructure the public transport sector. A lot of uncertainty. So higher staff costs are expected, higher depreciation because of a higher service standard, as well as that larger fleet of buses and the aging rail fleet. I also thought this paragraph just here was also very important. Bus losses will continue to widen, they warn, because of higher operating costs associated with higher energy and staff costs, which we looked at just now. Plus, they're also looking to replace and grow the fleet to meet the demands of the LTA when they say you've got to put more buses on the road so that the buses aren't as crowded. The current bus business model is not sustainable, and the group may have to impair its bus assets if the situation does not improve. Remember that $17 million impairment in the Shenzhen business? Well, that's nothing compared to what would happen if they had to impair the bus business. The group is in discussions with the government on more sustainable models for both its train and bus services or businesses. Those will have an impact on the short-term profitability, but improve the long-term sustainability of the business. Again, this is hard-hitting sort of stuff, and that's why the AGM is going to be so interesting. Higher capital expenditure is forecast for 2014, and expect some additional capex because of LTA's demands for peak hour traffic, travel fleets to be increased. The taxi business also remains positive, but at the same time, because there are caps on the number of taxis that they can put on the road, the increase in operating costs might impact the profitability of this business. By comparison, when you look at where those fares are compared to where they should be, you'll see exactly why this is such a difficult nut to crack. For train ridership, they need 1 percentage point in train ridership to result in a $6 million change in revenue. So they've got to either try to get more money out of your pocket every time you take the train, or they've got to encourage more people to travel. That, of course, assumes that there's no change in fares. Same with buses. I also think this is interesting. 1 percentage point change in bus ridership increases or decreases revenue by $2 million. Electricity costs. 1 percentage point change in the rates of electricity leads to a $1.3 million change in operating profit. So that you can see how very precise you can be here, measuring the increase in costs or increase in ridership and the impact on the business. It seemingly won't take much to move the needle, but in a market like Singapore, where if you are going to take the train, you're already taking the train, that is obviously going to have a big impact on the profitability of SMRT. Now to the other parts of the business. So we've discussed the fare business. Now is the non-fare business, and I find these three charts particularly interesting. The revenue bars are a lot shorter compared to train and bus revenue. Remember, bus was 220 million. Here we have rental at just short of 90 million, so less than half. But look at the profitability bars. Much longer. So a lot less revenue from rental and advertising, but a lot more profitable, which means that arguably SMRT would be better off if it wasn't a train and bus operator at all, but just focused on the rental and advertising and get somebody else to worry about the actual transport parts. And again, these two bar charts, which you can find in the annual report, bear that out. This down here is the earnings before interest and tax. This is the revenue, and you can see some very substantial numbers. These blue bars and orange bars don't move much at all when you compare the revenue from profit. In other words, they have some very good margins on both of these businesses. So you get the picture so far, right? That the operations will need to change. For those of you who are accounting buffs or actually like looking at the numbers, let's take a quick look through the group financial highlights for the last 5 years. Revenue has gone from 880 million to 1.1 billion, so that's a sizable increase. But then we come down here to where it says total borrowings. That's gone up from 150 million last year to more than 600 million this year, partly because of a $450 million note issue. Then cash and cash equivalents. We've gone from less than 200 last year to more than 500 this year. That's because of that $450 million note issue. So they've got a lot more cash on the balance sheet as a result of issuing that. Capital expenditure dipped from 500 million, just over half of that, 260 million. But as we heard in the earlier commentary, that's going to pick up again. Cash flow, pretty much consistent throughout. Free cash flow taking a real dive, though, from $239 million 4 years ago to just $12 million in the year just gone. And net gearing, in other words, the amount of debt compared to the amount of assets, from a net cash position the previous 3 years, they now obviously do have some debt on the balance sheet. The stock is currently trading at around $1.50, but it's actually, in value terms, in net tangible asset value terms, is actually worth only around 50 cents. So you're paying about 3 times book value. Having looked at all of that, let's focus in on the cash. Once again, we see that big blue bar, rather orange bar, where that $450 million fixed rate note is booked. So they certainly have the cash to be able to undertake some of these capital expenditures that they're looking to undertake. Lastly, 3 short bars, just for a bit of fun. The length of service profile is a quirky one because it shows just how long SMRT staff stay at SMRT. You can see here that this grey and this orange bar represent those people who've been working with the company for more than 10 years. So it looks like almost half of all their staff have been there for 10 years or longer. Provisions, another quirky one. Did you know, for example, that they've made provisions for accident claims of more than $43 million, which they expect to have to face during the current financial year? Again, you don't frequently see that reported in the papers. And last but not least, this is the key operating data. If you think that the trains are getting more and more crowded, if you look at page 85 of your annual report and you have a look at this table for yourself, you can see that the growth in ridership is up by 5%. And the total ridership has been 690 million in the 2013 financial year. But interestingly, the average car occupancy, passengers per car, has gone from 73 to 64. So statistically at least, it might not feel like that on the train, but statistically at least, it's not as crowded on the trains as it used to be. So there's a quick review of the SMRT annual report, main focus being operating expenditure, capital expenditure, the cut in dividends, and the big restructure that is awaiting us in the public transport sector here in Singapore.